Okay, it's just ticked over to 11 o'clock. Today's session, we are talking everything SMSF, the latest in SMSF compliance. My name's Matt Crofts. I head up the Simple Fund and Simple Invest 360 team. I'm joined here today by Lynn Formica. Lynn, welcome.
Thanks, Matt. Thanks for inviting me.
Great to have you. Lynn's got a wealth of experience, over 30 years experience in SMSF. If you haven't dealt with Heffron, they're based in New South Wales and Brisbane, and they are our partners today to take you through all the latest changes to get you up to speed. I'm really just going to do some basic housekeeping. We've also got Andrea from Heffron answering any questions today in the chat. I will be hanging around just in the chat to answer any software related questions. The good thing, everything that Lynn's covering today has been updated in the software, so I'm happy to answer any of those sort of questions that may come up in the Q&A. There will be a recording of today's session, and we will send out all participants an email with that recording. So that's pretty much it from me. I'm going to hand over to Lynn now. Welcome, Lynn, and over to you.
Thanks very much, Matt. I'll just share my screen and get the slides up. So essentially what I want to focus on in today's session is essentially a recap of what hasn't happened over the last few months. In the blur of 30 June or recovering from 30 June, it's sometimes really hard to stay on top of where things are at. So I want to walk us through a refresh of where we are at the moment and just point out any of those areas where we're likely to come unstuck with changes that have been made or are in progress. We will have time for questions at the end. As Matt said, Andrea Connor, our head of partnerships, is manning the questions box at the moment. She's going to filter through and we'll have she'll filter enough questions through to me at the end, the main issues, so that we can cover all of your questions. So definitely pop your questions into the questions box or the chat box. A copy of the slides will also be made available to you after today's session with the recording. So let's get started. So the first thing I wanted to cover off on is 6-member SMSFs. So you'll recall that there are a number of basic conditions that we need to satisfy to qualify as an SMSF. And the first of these is around the number of members. And importantly, making sure that historically that we've had no more than 4 members at any given time. And each of those members typically had to be individual trustees of the fund, or alternatively, we might have had a corporate trustee of our fund. So again, we had no more than 4 members, and all of those members needed to have been directors of the corporate trustee. Or alternatively, we may have satisfied one of the exceptions. So there are situations where we can have people who are members who aren't trustees or directors of the corporate trustee. So for example, where we've got minors, children under the age of 18, their parent or their guardian can be the trustee for them. Alternatively, you might have a member who's given an enduring power of attorney to someone else, and that someone else is the trustee or the director of the corporate trustee in their place. So that might happen in situations of incapacity or residency and those sorts of bits and pieces. So, those general requirements are still there in terms of all members being directors of the corporate trustee or trustees, individual trustees. But what we have had is the definition of an SMSF being changed effective from the 1st of July 2021. So SIS has been changed, and so now the maximum number of SMSF members is now 6. And that applies to new funds as well as existing superannuation funds. So I could set up a fund today that has no more than 6 members. Alternatively, I can add some members to an existing SMSF so that I again go to no more than 6 at any particular point in time. And we had some issues to start with, but the ATO has now updated the ABR so they can accommodate those changes. So you can now lodge your change of details or your ABN application form, including all of those additional members and trustees. The thing to watch out for, though, is that all we've changed is SIS. So the definition of an SMSF has changed in SIS. to allow us to have up to 6 members. But there are other legislation that comes into play when we're dealing with SMSF. So for example, some of our trustee acts in the various states limit the number of individual trustees to 4. So those states are New South Wales, Queensland, Victoria, WA and the ACT. So in those particular states, I couldn't have 6 individual trustees. The Trustee Act will stop me, even though a SIS would allow it, but the Trustee Act will stop me. So in that situation, I would typically have a corporate trustee, or ideally I have a corporate trustee for my self-managed superannuation funds anyway, for all of those great reasons as to why a corporate trustee is preferred over an individual trustee. Or alternatively, remember, as I said, there's those exceptions. So we could have someone who's a member of the fund, but is not a trustee because we've used one of those exceptions, like an enduring power of attorney, or the person is a minor under age 18. So in that particular situation, I could have 6 members, 4 individual trustees, if, for example, 2 of those members are minors, and one of the individual trustees is their parent or their guardian. So just remember those exceptions still come into play when we're dealing with 6-member funds. So if you're getting inquiries from clients around 6-member funds, it is important to understand the pros and the cons, and there is a large number of cons. I'll talk about the pros first. So essentially, yes, there can be cost savings. If you've got people who are all members of the same self-managed superannuation fund, we've saved the cost of having other self-managed super funds, or alternatively, we're rolling in monies from retail funds where they might have had their fees based on a percentage of their balance, as distinct from an SMSF where the fees aren't generally dependent on your balance. It's also very handy when we've got intergenerational wealth transfers going on, those sorts of things. So where we've got a self-managed superannuation fund because we've got a particular asset in that fund that we want to retain through the generations as possible, and we want to leave it inside the superannuation fund for as long as possible. So historically, that has meant when mum and dad are eligible to draw on their benefits, they're taking money down, so they're diminishing their balances. And we've got, say, the adult children, now perhaps up to 4 adult children plus mum and dad as members of the fund. They're making contributions, and over time, mum and dad's balance is dropping, but the kids' balances are rising, such that eventually their balance will be at least the size of the value of that property. And when mum and dad pass away, we won't be needing to sell that asset from the fund. So it's a way of retaining that asset inside the fund if all our dollars align. Also helps from liquidity in general. If you've ever had a client which's got a problem having enough liquidity to make pension payments, those sorts of things, adding members to the fund, if those new members can roll over balances, can make contributions, it can help us from a liquidity point of view. Even where we've got LRBAs, if we're struggling to finance an LRBA, of course, the more members in that fund, the more contributions, the easier it is to get finance for that LRBA. If we're in the unfortunate position of having reserves inside a self-managed super fund, the more members in the fund, the higher the balances, the quicker it is to dissipate those reserves, make allocations to them from the reserve without having it counted towards their contribution cap. So there are certainly some advantages, but we do have to watch the disadvantages. And the biggest one is around control. So I had a conversation with a client the other day. So he considers the fund to be his. And the other members of the fund at the moment are his wife, and he's got 2 minor children, so children under the age of 18. And he's thinking of bringing in his 2 adult children. Now they have 6 members in that SMSF. So we were talking through the pros and cons of that. If those members joined the fund and they became directors of his corporate trustee, whether that would put him in a position where they could effectively outvote him. So that's where it's really important in that situation to understand how the voting rights work in a particular superannuation fund. For his fund, we had to look at the constitution of the company and can see who controlled the company. If I've got individual trustees, then I'm looking at the governing rules of the fund to work out who can control. So in his particular situation, because voting powers were based on per head, if those adult children became directors of the corporate trustee, they could have effectively outvoted him. And so we talked through options of perhaps those adult children became members, but they gave dad an enduring power of attorney over their affairs, and they were then not directors of the corporate trustee. Now, I could have that conversation because my client is the current trustee of the fund. But if my client was those adult children, I would probably be having a completely different conversation, because would it be in their best interest to be joining dad's fund when they've got no control over the balances in that fund? So always thinking about who your client is here when you're having that conversation. Also need to bear in mind, and my client needs to bear in mind, that as trustee, he needs to make his decisions in the best financial interests of all of the beneficiaries. So it's not just about looking after himself. He needs to be making sure that all of the other members of the fund are being looked after, including those adult children who aren't directors of the corporate trustee. So that might require different investment strategies, in which case maybe it might not have been as cost effective as he thought it was going to be. And importantly, when we're adding members, and I'm not just going from 4 to 6, anytime I add an extra member to a self-managed superannuation fund, I have to think about what sort of mechanisms I might have for resolving disputes. Self-managed superannuation funds don't work well from a dispute point of view. You know, there's no tribunal that we can go to resolve our disputes. So ideally, if there's, you know, I heard one solicitor say on one particular occasion that there should only ever be one member and one trustee of a self-managed superannuation fund. And I have to agree, because usually you're not in dispute with yourself unless you're having a particularly difficult time. It can be hard to create a dispute resolution mechanism that's going to work all of the time in an SMSF. But certainly they're the things to think about if you've got client inquiries around 6-member funds. One of the other things that they changed when they were amending the provisions around 6-member funds was in relation to who can sign the financial statements. So what I mean sign the financial statements, I mean the person who can actually sign off to say that these financials represent a true and fair view and of the operations of the fund. So can authorise the signature on the financial statements. So if I've got individual trustees, then if there's 2 trustees, both of them have to sign off on those financial statements. Otherwise, if there's more than 2 trustees, they need to be signed by at least half of the trustees. Alternatively, if I've got a corporate trustee, if there's 1 or there's 2 directors, each of them need to sign. Otherwise, again, we're looking for at least half of the directors to be signing off on those financial statements. And importantly, just remember that it's the trustees or the directors at the time of signing which is relevant here, not who the trustee or the directors were at the year end. So if at 30 June 2021, I had mum and dad as the members and individual trustees of my self-managed superannuation fund, but by the time I present the 2021 financials to them for signing, it's December 2021 and dad's died. And perhaps mum is sitting there as the sole individual trustee at that particular point in time, then it's only her who's signing. So I'm not looking for who the people were at year end, it's who they are at the time they're making the decision to sign the financial statements. Okay, so the next issue I wanted to cover off on is around the transfer balance cap and the indexation of it effective the 1st of July. But to do that, let's just have a recap of where we are at just from a pensions point of view, and then we could specifically look at the transfer balance cap issues. So if we look back to where we've been, 2021, so remember we had the halving of the drawdown rates, the minimum pension drawdown rates for our account-based pensions, our TRISs and our market-linked pensions. Our general transfer balance cap was $1.6 million. And for those of you who've got clients who have lifetime pensions started at any time, or life expectancy or market-linked pensions started before the 1st of July 2017, you'll know they're called capped defined benefit income streams, and those pensions are taxed differently. And for them, the thing that is relevant, rather than the transfer balance cap, the thing that's relevant is their defined benefit income cap, which last year was $100,000 per annum. They're the ones that we issue payment summaries for those pensions, regardless of the amount of pension they have drawn. And in relation to those very special types of pensions, they're non-commutable pensions, and at this very moment, we're not permitted to commute them. We can't take a lump sum. We can't roll them back to accumulation phase. We can't turn them into account-based pensions instead. So that was 2021. Where are we at right now in 21-22? Well, we have a continuation of the halving of those drawdown rates. Was quite surprised when that happened, but we do have the halving for this particular financial year. Of course, our general transfer balance cap got increased to $1.7 million, and that then impacted our defined benefit income cap. So that's why it also has grown to 106,250, and we're still not allowed to commute those special pensions. Where are we going forward? So we would expect for next financial year, 22-23, that we would be back to our normal drawdown rates for our account-based pensions. So if I had someone who was under age 65, we expect that 1 July 2022, I'll be back to a 4% drawdown rate rather than the current 2%. Not expecting any additional indexation of our transfer balance cap. It took us 4 years to get enough of a CPI increase to get us up to 1.7. Not expecting any change in the next 12 months. But for those of you with those special legacy type of pensions, it may be possible for us to commute those. The government has, in the May federal budget, they did announce a 2-year amnesty, or their intention to have a 2-year amnesty commencing the 1st of July 2022 to allow us to commute those pensions and take them back to accumulation phase, take them outside super. We may have to take them outside super if it's a death benefit type of pension. If we can possibly make some room within our transfer balance cap, then we might be able to put some of it into an account-based pension. But that hasn't been legislated yet. We've not even seen draft legislation on that yet. So let's now step across to the indexation. So remember, it's the general transfer balance cap that got indexed on the 1st of July 2021 to this $1.7 million. The impact on each of your clients' personal transfer balance cap depends on the highest ever balance they've had in their transfer balance account as at 30 June 2021. So transfer balance account, that's the little running balance we've got, running tally that we keep of whenever your clients have commenced retirement phase pensions, credits to the account, or whenever they've commuted monies from a retirement phase pension, we end up with a debit to the account. So we've got a running tally there in our transfer balance account, and our indexation depends on the highest ever balance we got to in that transfer balance account. So for example, if you have a client and the balance of their transfer balance account had ever equaled or exceeded $1.6 million, then they don't qualify for any indexation. So their personal transfer balance cap has remained at $1.6 million. Alternatively, you'll have a whole range of clients who've not yet had any entries in their transfer balance account. They don't even have one of those accounts yet because they've not started a retirement phase pension yet. So they've got the full $1.7 million available to them, or whatever that 1.7 has grown to by the time they do start to take retirement phase pensions. Or you'll have someone who fits in the middle. So you'll have someone who had a transfer balance account prior to the 1st of July 2021. The highest ever balance was less than 1.6. So they get this proportionate amount of indexation, which you've probably seen the little calculation that needs to happen. So essentially, I've got my example here of Brian. He first started a pension with a value of $700,000. That locked in place his personal transfer balance cap at that time of $1.6 million. And then he's had various entries over the years, stop and restarts, those sorts of things, such that his balance at 1 July 2021, his transfer balance account has a balance of $1.2 million. But to work out his indexation, I've got to work out what his highest ever balance was, which was that 1.406. I express that as a percentage of his transfer balance cap, tells me how much of his cap is used. He's used 87% of his cap. He's got 13% he hasn't used, and he gets 13% of $100,000 as his indexation amount. So Brian's new cap becomes 1.613 million. So I'm sure that's stuff that you've already read and seen in the lead up to 30 June 2021. What I want to do though is just sort of dispel a few of the myths around transfer balance cap and indexation. So the first of them, do I need to calculate this index transfer balance cap for every one of my clients effective 30 June 2021? Definitely not. For a lot of your clients, it will be completely irrelevant. Those clients who will never get anywhere near their transfer balance cap, we don't need to calculate it. It doesn't matter whether it's 1.6, 1.7 or somewhere in between. You've got a client, she's single, she's 78 years old. She has $800,000 so far, which has been counted towards her transfer balance account. She doesn't have a home to sell. She's not likely to make a downsizer contribution. She's too old to make any other type of contribution. She doesn't have a partner, so she's not likely to inherit any superannuation. So for her, it's completely irrelevant that, yes, I could do the calculation and work out that her index cap is 1.65, but I don't need to. It's irrelevant for her. Even the clients who perhaps have $500,000 each, husband and wife who've got $500,000 each, which has been tested towards their transfer balance account. Presumably when one of them passes away, the intention is to pass the money across to the surviving spouse. But even the combination of those monies is not going to take the survivor over their transfer balance cap. So I don't need to worry about it for them either. Really where I need to look at is those clients who are still contributing or likely to contribute in the future, maybe downsizers, CGT cap monies, all of those sorts of bits and pieces. They'll want to know how close they are to their cap and what that cap actually is. Even when they're making a contribution, they might be curious to know, if I make this contribution, how much of it could I then get to pension phase? So they're the clients that you need to focus on. Oops, going the wrong way. Is that index transfer balance cap information available for all of my clients now on ATO Online or MyGov? It certainly is, but be very careful with that information at the moment on ATO Online or MyGov. Not because there's any problems in the data, but that information, the ATO's calculation of your client's index transfer balance cap is only as good as the information you've given the ATO. So if there are events that haven't yet been reported, events that would use up more of your client's transfer balance cap, if the ATO doesn't know about those events yet, then they will think your client is entitled to more indexation than they were. So we need to make sure that we bear that in mind, because we don't want to look on ATO Online and think, my client has a cap of 1.65 now, and work towards that with a contribution strategy, or perhaps with working out how much needs to be rolled back to accumulation phase because they're inheriting money from their deceased spouse. Any of those sorts of bits and pieces, I need to be very careful about relying upon that information on ATO Online, because if I haven't yet reported an event, the figure will be incorrect. And remember, SMSFs have different reporting dates to non-SMSFs. So if you want to do your own calculation for planning purposes, you don't want to run it through the software, but Heffron have a transfer balance cap calculator. It's free, and you can jump in there and do a bit of planning to work out how much cap space a client is likely to have. So I've given you the link there on the slide. So just a reminder of those lodgement dates when I said SMSFs have different reporting dates to non-SMSFs. So for an SMSF, you're either an annual or a quarterly reporter, and that depended on whether any member of the fund had a total superannuation balance of more than $1 million at 30 June 2017, if we had retirement phase pensions in place at that time. Otherwise, we do that assessment against that $1 million as at the 30 June prior to our first event happening in relation to transfer balance cap. So if you were less than the 1 million, then you're an annual reporter. If at least one member of the fund had a total superannuation balance of more than $1 million, then you're a quarterly reporter. Now, that decision is locked in for life then of that fund. So once you're tagged as an annual reporter, you'll stay an annual reporter, regardless of the growth in people's balances. Similarly, if you were a quarterly reporter, even if your balances have diminished, you stay a quarterly reporter. We often get questions about whether we're likely to get penalties if we're not lodging our T-bars on time. To my knowledge, no one yet has been penalised for late lodgement of a T-bar. Certainly the rules allow for it. It's the Tax Administration Act item, so the normal late lodgement penalties could apply, just like any other late lodgement, any other form. So I think the figures at the moment is like $222 for every 28 days that it's late for up to about $1,110. So they could be potentially significant penalties, but my understanding is the ATO haven't done that yet because they're still effectively working on an educational type of phase. Other question I often get is, are we likely to have to go to quarterly reporting for all of our SMSFs? Will they eventually get rid of this annual reporter concept? I can't say they've never talked about it. I know they have talked about it. As you can imagine, they get beaten down pretty quickly when that sort of thing is discussed. So, yes, it may change in the future, but I certainly don't know of any moves to do that in the near future. Okay, next thing I wanted to cover off on then is non-concessional contributions. And that's particularly because we've had some relatively significant changes in relation to non-concessional contributions. But again, like I did with pensions, let's sort of have a recap of contributions generally, and then we can focus on the non-concessional side of things. So where we've come from, 2021, in terms of contributions, we know that age 67 was our trigger point for needing to meet the work test for a contribution to be accepted. So historically it was age 65, 1 July 2020, they upped that to age 67. So I don't need to meet a work test till I have my 67th birthday. And of course, if it's a mandated, like an SG or an award contribution, or it's a downsizer contribution, I don't need to meet the work test at all. And we still have our age 75 cutoff date as well. If it's a downsizer contribution, I need to be at least age 65. Our concessional contribution cap was $25,000 last year, and the non-concessional cap was $100,000, provided I had a total superannuation balance at 30 June 2020 of less than $1.6 million. Bring forward mode, so that option where I could make effectively 2 years or 3 years worth of contributions, used to have a cutoff age of the year we were turning 65. That has changed. It is now 67. So that was a very last minute change in June 2021, backdated to the 1st of July 2020. So I'll explore that a little bit more detail, but certainly it did get changed. The trigger date is 67 now. So this current financial year, we had the changing to the cap. So as you know, concessional contribution cap is $27,500 now, which means the non-concessional contribution cap is 110 because it's 4 times what our concessional contribution cap is. But I've got to have a total superannuation balance of less than $1.7 million to be entitled to that $110,000 cap. Where are we going forward? As part of those federal budget proposals back in May, the government had proposed that they would only require a work test for at 67 for personal deductible superannuation contributions. So we would no longer need to meet a work test to make a non-concessional contribution. So I could make non-concessional contributions right through to my 75th birthday, or just prior to my 75th birthday, without having to meet a work test. But we will still need to meet the work test if I want to claim a tax deduction for that superannuation contribution, and that work test will kick in at 67. They're also proposing to drop the eligibility age for downsizer contributions, and at the same time increase our age for triggering bring forward mode for non-concessional contributions right through to 74. So we'll have the ability for people to make non-concessional contributions without meeting a work test and make large non-concessional contributions, potentially triggering bring forward mode for a much longer period. Of course, always subject to their total superannuation balance. But those changes have not yet been legislated. We haven't even seen draft of them yet, and they don't start until the 1st of July 2022. So I know some people are getting a little bit confused. They're thinking that the work test has gone for non-concessional contributions already. It hasn't. In this current financial year, if your client is making a superannuation contribution, unless it's a SG or an award or a downsizer contribution, if they've had their 67th birthday, they'll need to meet the work test, and it'll cut off at 75, or technically correct, it'll cut off 28 days after the end of the month in which they turned 75. All right, so let's focus now on our non-concessional bring forward. So as you'd know, our ability to utilise bring forward and the amount that it entitles us to depends on our age, our total superannuation balance, whatever the general transfer balance cap happens to be, and whatever the standard non-concessional contribution cap happens to be. But I can trigger it. I can get myself into bring forward mode, if I can call it that, if I'm under age 67 at any time in that trigger year. And of course, I have to be not partway through an already existing bring forward mode. Whatever my total superannuation balance is at the previous 30 June. So if I'm triggering bring forward mode, in that particular example, I'm triggering bring forward mode in 2021. I'm looking at my total superannuation balance at 30 June 2020 to determine what my bring forward amount and period would be. So if I'm entitled to trigger it, so I was under age 67 at that time, my total superannuation balance, if it's would determine whether I've got a 3-year or a 2-year period, and whether I've got 3 times or 2 times my general cap. So you'd be familiar with this table these days. So covering what the caps were last year versus what the caps are this year. So, we've all got the 1.4, 1.5, 1.6 in our heads. We've got to replace that with a 1.48, a 1.59, and a 1.7. So if my client's total superannuation balance is less than 1.48 million at 30 June 2021, and they meet the age requirements, then they have a 3-year bring forward period and $330,000 over that 3-year period. So just some of the traps people fall into in terms of bring forward mode. So just remember, it's an automatic thing. We call it bring forward mode. We don't choose it. We don't make an election to use it. It's automatic. If I meet the age criteria, so under age 67 at any time in the year, previously it was 65, my non-concessional contributions that have been allocated to me are more than the standard cap, and I'm not already partway through a bring forward mode, then I will automatically fall into bring forward mode. I don't get to say, oh, actually, I would have preferred I didn't trigger it that year. Can I just take the extra as an excess and I'll trigger it bring forward next year? Fortunately, it doesn't work that way. Just the same, I can't choose my amount or my period. So they're just a function of my total superannuation balance. And importantly, in this changeover from a $300,000, or I should say, changeover from a $100,000 standard cap to 110. Once I trigger bring forward mode, I will lock in what that bring forward amount is for that period. So if you've got clients who triggered bring forward mode in 2021, and they were entitled to a $300,000 non-concessional contribution cap, then they don't get the benefit for the fact that the $100,000 cap grew to 110 in this current financial year. And even if they didn't use all of their bring forward amount in 2021, so they only contributed $180,000, they don't get any benefit of the indexation. So they are stuck with a $300,000 limit. It's just not adjusted when you're partway through. The other thing that sometimes tricks us up with bring forward mode is in those clients who don't utilize all of it in the first year. So I know that we generally encourage clients, if you're going to trigger bring forward mode, make sure that you use all of it in the first year. Otherwise, you risk not being able to utilize the remainder. And I say that because, for example, if I've got a client who they triggered bring forward mode, say in 1920, and then they want to finish it off in 2021. So perhaps they had a $300,000 bring forward amount and a 3-year period, but they only contributed $180,000 in 1920. Then our problem was to be able to finish that off, to contribute the remaining $120,000, I had to have had a total superannuation balance of less than 1.6 at 30 June 2020. It didn't have to be much under, dollar under, in theory, would have been sufficient. If it wasn't, then my non-concessional contribution cap in 2021 was actually nil. You think it's $120,000, but it's not, it's nil, because of the fact that you exceeded that total superannuation balance threshold. So those figures, that 1.6, that's changed. So effectively that's now 1.7, because the general transfer balance cap has grown. That figure becomes 1.7. So it does make it a little bit easier for us, for perhaps where our clients' balances have grown. So, you're talking about somebody who was just under the 1.4, but their growth means that the bit they have contributed plus the growth takes them over. Well, hopefully they're not over 1.7 now. The other thing that sometimes trips people up is around this turning 67 and the interplay between the work test, triggering bring forward mode, those sorts of things. So let's pretend my client, Fred, we'll call him, he's going to turn 67 on the 1st of January next year, so 2022. But for cash flow purposes, he's not going to be able to make his contribution until the 1st of April 2022. And let's assume it's not a downsizer contribution. So it's one that we would normally need to meet the work test. So we know he can pop a contribution in before his 67th birthday without needing to meet a work test. But in his situation, he's not going to be able to put the contribution in until after his birthday. So that means he's in the situation where he has to meet the work test. He just has to meet the work test at some time in this financial year and before the 1st of April. He doesn't need to be working at the time he puts the contribution in. He just needs to have met the work test, as I said, sometime in that period, 1 July 2021 to 1 April 2022. Unless, of course, it's an SG or award or a downsizer contribution. If we combine that then with bring forward mode, so given his age, he's turning 67 in this financial year. So this financial year, he's entitled to trigger bring forward mode. So he can trigger bring forward mode at any time in this 21-22 financial year, provided his total superannuation balance was less than 1.59 at 30 June 2021. That would have given him a 300. So that would give him a 2-year and a 220,000. If it's less than 1.48, he'd have a 3-year bring forward amount. 3-year bring forward period and a $300,000 bring forward amount. But of course, if that contribution is going to go in after his 67th birthday, he has to meet the work test to be able to get it in. So for Fred's situation where he's going to pop his contribution in on the 1st of April, that's fine. So it's perfectly okay for him to put the contribution in after his 67th birthday. He's still entitled to bring forward mode, but he has to meet the work test. So he has to have met that work test at some stage before he puts that contribution in that 21-22 financial year. Now, of course, that starting age I've got on the left-hand side there, that's what used to be 64. So it's grown to 66. That's the bit they played with. Also important to just keep your eye on that other proposed change, as I said. The government has proposed that they will extend the ability to trigger bring forward mode until you get to 74. So that was part of the May federal budget announcements. We haven't seen a draft yet, and it's not to start till the 1st of July 2022. But for example, you might have a client who's, they're 66 at the moment, turning 67 in this financial year. So this is going to be, under the current rules, their last opportunity to trigger bring forward mode. So they might be planning to put $330,000 in before 30 June, knowing that if they're going to put it in after their 67th birthday, they'll have to meet the work test. So that would then utilise their bring forward period for 22, 23 and 24. That would be their 3 years. But given this proposed change, if the aim is to get as much money into superannuation as possible, then they might be looking at, in fact, putting 110 in, holding off, just doing 110 in this current financial year, not triggering bring forward mode, because they know they can still trigger bring forward mode next year if the eligibility age changes out to 74. So that would give them the opportunity to get $440,000 in a relatively short period of time. Of course, subject to total superannuation balance. And that's something that we always have to bear in mind whenever we push out a non-concessional contribution. We might end up with a situation whereby our total superannuation balance has grown and taken us over a particular threshold. But just with those changes, we may very well have lots of contribution strategies around no longer needing to meet a work test, being able to trigger bring forward mode for a much longer period of time. So it's certainly something to watch out for 1 July 2022. Last thing on non-concessional contributions, we have a new amount that is not, that can effectively, we can elect to have not counted towards our non-concessional contribution cap. So we call it a COVID-19 recontribution. So these are the people who validly drew monies out of superannuation under the COVID condition of release, that special condition of release that allowed us to take up to $10,000 from our preserved super in 1920, and then also partially in 2021 if we met the eligibility criteria. Well, now we can put that money back. We can pop it back in and have it not counted towards our non-concessional contribution cap. We've got 10 years, in fact, to do it between 1 July 2021 and 30 June 2030. Need to meet the normal acceptance rules though. So if normally you'd need to meet a work test, you'll still need to meet a work test to put that contribution in. Can't claim a tax deduction for it, and you'll need to make an election to have it not counted towards your non-concessional contribution cap. And I believe the form has only just become available to make that election. And of course, the maximum amount you can put back in under this proviso is the amount that you took out. So if you only took out $9,000 under the COVID-19 condition of release, then you can only put back $9,000. I call this the Pauline Hanson change. Essentially, this was one of the changes that One Nation lobbied for as part of their agreement to pass the bring forward rule changes in June 2021. So that was one of the things that they had insisted upon. So I'm not sure how many people will do it, but that's what we're talking about. If you see the concept of a COVID-19 recontribution, that's what one of them is. All right, so what's ahead for us? SuperStream. So you may have heard that there are some changes happening to SuperStream, and they'll start from the 1st of October 2021. So SuperStream is around transmitting our data electronically. So at the moment, we use SuperStream where we've got a rollover from an APRA fund to a self-managed super fund. If we've got employers making contributions to non-self-managed superannuation funds, or we've got employers making contributions to self-managed superannuation funds, but the employer is not a related party of the SMSF. They're all still going to stay there, but from 1 October, there's another range of transactions that we'll have to do via SuperStream. So APRA rollover to a self-managed superannuation fund, SMSF rollovers to another SMSF, SMSF rollovers to APRA funds. So this will cover the situations, when you first set up a self-managed superannuation fund and you want to have a rollover in from the APRA fund, have to do it via SuperStream. If you've got maybe a family law split, people, business partners breaking up, they're going from one self-managed super fund to another, we'll have to do it via SuperStream. Or when in fact we're perhaps wanting to wind up the fund and we want to roll out of our self-managed super fund and go to an APRA fund, we'll have to do it via SuperStream. So BGL will look after you from that perspective once the rules once the kickoff date of the 1st of October 2021. The other change to watch out for is around non-arm's length expenses, NARLI, and we just need some further clarification from the ATO. So just recapping, tax law was amended 1st of July 2018, so that all or part of a fund's income may be taxed at the 45% rate. So even when they'd normally be no tax because you're in pension phase, it's taxed at the 45% rate as non-arm's length income, NALI, if there's a scheme, the parties to the scheme are not acting at arm's length, and the expenses which have been incurred by the fund are less than they would have been in an arm's length situation. And we call those non-arm's length expenses. So for example, if we've got services being provided to an SMSF, the person providing the service is the trustee of the fund or some other entity which have been engaged by the trustee, and the fund isn't charged for those services, or they're charged an amount that is less than an arm's length amount, then all or part of the fund's income may end up as NALI. So we've had the ATO a month or so ago issue their ruling on the issue, LCR 2021/2. It has given us some clarity, but there's lots more clarity that needs to come. So things like they differentiate between a trustee duty, which you don't need to charge for, and it's good because in fact SIS stops us charging for those sorts of things, versus an individual a service you provided in your individual capacity. So we just need some more clarification from the ATO around what's a trustee duty, the issues around staff discounts. We know that there's ATO has continued with their compliance relief for expenses that relate to the fund as a whole, so general expenses through to 30 June 2022, but there's just a lot of clarification that we still need to come. So I'm having conversations with the ATO to get you that clarity. So what else do we have coming up? So in October, we have Heffron's signature event for the year, our super intensive day. So something like non-arm's length expenses, I'll be exploring that in some detail at our super intensive day. So that's we'll have all of those answers from the ATO on what exactly we need to do. Other things that we've covered today, Meg will be exploring in her superannuation landscape session some more strategies around those contribution changes that I've covered today. Lee will be walking through some of the quirks around the SMSF definition. I'll be covering like, what do you do when the clients muck up the contribution rules or they muck up the pension rules? How do we fix those sorts of things? We've got other sessions on incapacity, death, the investment rules, all those sorts of bits and pieces. So I'm really looking forward to that. And I'm really excited because we're going to be launching our new online learning program called Education Bites. And anyone who's registered for the super intensive day will get 3 months free access to Education Bites, which is worth about $150. So it's my new baby. I'm really excited to be launching it and showing everybody this new micro learning concept around super and SMSFs. But on that note, I will hand over to Andrea with any questions that she wants me to answer.
Thanks, Lynn. That was very comprehensive. We've had some excellent questions during the presentation. So probably one of there was a little bit of confusion just around the 6-member fund and the trustee laws, and so talking about whether or not you can have 6 members, and so there was a little bit of confusion about that. So did you just want to cover off on that again around, when you can have a 6-member fund and which states that's with the trustee laws?
Yeah. So essentially, 6-member fund, that's a provision in the Superannuation Industry Supervision Act. So that's across Australia. So everyone in Australia can have a 6-member self-managed superannuation fund. But the trust rules are state-based. So our Trustee Act in New South Wales, for example, requires or limits us to 4 individual trustees. Same in Queensland, WA, ACT. So I believe it's only South Australia, Northern Territory, which can have more than 4 individual trustees. So if I want a 6-member fund in New South Wales, I'll either go to a company that I could have all of those members being directors of the corporate trustee, or alternatively, I'll have to have some of my members give an enduring power of attorney to the other trustees so that I could have someone as a member and not be a trustee, because I'm stuck with a 4 individual trustee limit. Does that clarify that, Andrea?
Yeah. That's excellent. Yep, I think that will clarify some of the questions on that one. The other great question was, will they need to update the deeds of the funds?
Yeah, depends on your existing deed. So certainly if you've got a Heffron trust deed, it doesn't need to be updated. So certainly 3.0 doesn't need to be updated. Essentially, we try with our Heffron deed to not hardwire things like that into the deed. So certainly once SIS is amended, then those things are already incorporated in a Heffron deed. But you'll have to look at each of your trust deeds. If you do have a deed that specifically says you can have no more than 4 members and you want to go to more than that, you will need to update your deed first.
So Mark had a question around transferring. Could we cover off on so transferring between SMSFs? So we've particularly if they're wanting to combine 2 SMSFs and make it a 6-member fund. So what's the what are the issues in doing that from transferring the assets and things like that?
Yeah. So if I've got 2 self-managed superannuation funds and I want to move the assets and combine them into one, then there's a couple of things that we need to watch out for. Those 2 self-managed superannuation funds will be related parties of each other. So we need to make sure that we can satisfy the rule which says that normally we're not allowed to acquire assets from related parties, but we're allowed to acquire listed shares, listed securities, and units in widely held unit trusts. So your managed funds would typically qualify as widely held unit trusts. So those sorts of things can be transferred across from one fund to the other. The only restriction, so for example, we had residential property in one fund, we couldn't move that to the other fund unless we were doing it for a family law splitting purpose or something like that. Only business real property could be moved across. So that's our first thing, making sure that we're going to meet the transfer requirements. And then if we're going to do this after the 1st of October, any of the cash, we'll do that electronically via SuperStream. And if we've got an in specie transfer of assets, then we'll just do that via paper like we normally would.
Yeah, okay. So we also, there was a couple of comments around the fact that they don't seem to have updated the SIS Act in regard to, so Section 17A in regard to the 6-member fund. So that's just the fact that they haven't.
Yeah, it depends on which one you're looking at. So it has gone through royal assent. So it is in there. It is law effective the 1st of July 2021. It might just be that the particular act that you're looking at hasn't been. If you jump onto the ATO website, go via the legal database and check the act via there, it has been updated. Yeah.
Excellent. We had a question in regard to gainful employment. So when you were talking about the contributions and the gainful employment, I did answer most of it, but one of it was whether or not if they were doing voluntary or charity work, would that be classed as gainful employment?
Unfortunately, it doesn't. So the gain or reward has to be monetary. So it can't be, you personally growing by virtually being able to do that charity work. So no, you actually need to receive some monetary compensation for the work that you're doing.
So we had a couple of questions around the work test and turning 67 in a particular year, and at what stage does the member need to meet the work test? So say, for example, if their birthday is in December and they're turning 67 in December, but they can't make the contribution until closer to 30 June in that financial year, if they had met the work test during that year, would they still be eligible?
Yeah, so we just need to have met the work test before the contribution goes in. So if my contribution isn't going to go until the 1st of June, for example, then I need to have met the work test before the 1st of June, but at some stage in that particular financial year. So that could have been before my birthday, it could have been after my birthday. Just needs to have been met before I put the contribution in.
Excellent. Also, we're still getting questions in regard to the 6-member fund, just around whether or not do all individual trustees, directors need to, hold on, let me find that one. Do all 6 members need to be directors or individual trustees of the fund? So that question's still coming through.
Yeah, so generally speaking, the default position is that all members need to be individual trustees or directors of the corporate trustee. But there are exceptions. So for example, a member who's under age 18 can't legally be a trustee. So SIS provides an exception for them. They can still be the member of the fund without being a trustee or a director of the corporate trustee if their parent or their guardian is a trustee for them instead. So that's one exception. The other one that's most commonly used is what we call the enduring power of attorney exception, or the EPOA option. So, for example, if Andrea and I wanted to both be members of a self-managed superannuation fund, but I really don't want to be bothered with the legal liability of being a trustee of that fund or a director of the corporate trustee, if I gave an enduring power of attorney to Andrea, then that is basically my ticket to say that I don't need to be a trustee of that fund. Andrea is basically acting as a trustee for me. So she'll be there representing her own member balance, also representing mine. I'm sitting there as a member, but I'm not actually a trustee.
Yeah, so it's a similar rules to what's been in the past. So and you can have a director that's not a member as well, can't you?
Yeah, so if I've got a single member fund, is that what you're thinking of? So I can have a single member fund that I've got a director who's not. So in a single member fund, I can have the member as a director plus one other. So those rules haven't changed. The only thing that we've changed is basically allowing us to have 2 more members in the fund. Yeah.
Excellent. So with the, Lee's got a great question in regard to the COVID recontributions. Do they count, are they subject to the transfer balance, the TSB?
So no, so we're basically not counting it towards we're not counting it towards the non-concessional contribution cap. So we don't need to worry about TSB. Once it's in, it will be included in my TSB calculation because it's part of my member balance. Yeah.
Yep. Excellent. We've got a couple of questions that have got a fair bit of detail in them. So with lots of balances and things like that. So I'm just wondering whether we're probably best to answer those ones offline, or because they probably need a little bit more thought put into them.
I might need my calculator.
We've got one here. If transferring assets from one fund, say a 2-member fund, to another fund, which will become a 6-member fund, is there CGT rollover for the transfer?
No. So the only CGT rollover would be if you were doing, if someone was rolling for the purposes of as a requirement of a family law split where couples had separated. That's the only CGT rollover provisions. They didn't incorporate any extra CGT rollovers like we had when we have large funds that combine and those sorts of things. None of that sort of functionality none of those sort of concessions were provided with the 6-member rule. So CGT will still apply.
Okay. So I've got Joanne who's saying, so if it's not a single member fund, so if it is not a single member fund, all directors and teamsters must be trustees, must be members. Sorry, I asked, but I am getting different advice on this.
Yeah. So if I'm not a single member fund, so I've got multiple members in my fund, do all directors need to be members? Not necessarily again. So I might have, for example, again, it might be Andrea and I who are the members of the fund. And I've got an enduring power of attorney. Perhaps I'm incapacitated, and before I lost capacity, I gave an enduring power of attorney to my husband Tony. And so my husband Tony could be the director of the corporate trustee for me. He doesn't need to be a member of the fund. So we have 2 members, Andrea and I, and 2 directors of the corporate trustee, but that's Andrea and Tony. So Tony is a director without being a member. I'm a member without being a director.
Yep. And just Selena's just asking whether or not we can now do the change of trustee through the ABR, like the online registration. I think we can now, can't we?
That's right. I haven't physically tried it myself, but my understanding is that the ABR has been updated and you can lodge, you can physically do it online, those changes rather than having to do a paper form.
So we've probably got a couple more questions there that we can come back to the people in regard. I'm just conscious of time. So there's some questions there that we haven't answered, but we can probably do that via email or after today. It's only 1 or 2 questions there. That you might need your calculator.
Yeah, sounds good.
Yeah, excellent. That was great questions and obviously lots of engagement, which was fantastic.
Thank you for doing that, Andrea.
Thanks, Andrea. Thanks, Lynn. It's just gone midday, so we really appreciate your time and very concise answers you've squeezed in there, Lynn. We thank you very much for educating our users. I will send through those question lists to yourself, Andrea, so you can follow up on those. And certainly anyone that came late, there will be a video recording and the presentation will be sent out to all participants. So that's pretty much it. Thanks very much, Lynn. Thanks, Andrea.
Thanks for inviting.